Hi everyone, my name's Andrew. This is quite a new project that a group of us have been working on. So it's called AGANT, which is building a GBP stablecoin on chain. It sort of came about as a bit of a It just sort of happened, really. It was a conversation with some lawyers that seemed to snowball, and here we are. But really, the key principle for us was there was a frustration that there isn't the ability to be on chain in GBP. There are options that exist, but they're not particularly great. And also the way that blockchain's going and sort of bringing it into sort of the real world, to us it feels like the next logical step in terms of like payment rails and as we look to try and bring transactions from T2 to T1 and now into T0. Instant settlement and clearing is going to be a big thing going forward. So I made sure when I said to Colin that I wouldn't shell my own project. So this is a more sort of general focus of some of the challenges that we've had to focus on sort of going forward, and the key part of our project is sort of compliance and building on that transparency and trust side of things. And so it's been a real focus of ours to work with the regulators. We've had conversations with the Bank of England and the FCA to really understand, how policy that's being developed is going to be implemented, and how we can influence that going forward as well. So I guess, the best place to start is really just to describe what a stablecoin is. It's actually interesting the amount of people that don't really understand what a stablecoin is. People have this perception that it's an asset that doesn't move, and that's very true. But the way that the asset is backed is also very important. So yeah, it's just a type of digital asset that's pegged to the value of another asset. In this instance, it's fiat currency. So I'll skip through that slide. I guess just to touch on what we are doing, our vision where we wanted to approach this from was to create a compliant, trustworthy, transparent network that individuals can transact on, in a cross-chain environment that gets the borders and the frustrations away that current transactions have. And I think it's easy to look sort of further afield and see how that works, from an international payments point of view, but also, internally in the UK at the moment, for example, merchants have to wait 3 to 5 days to have their, any transaction settle and clear. Whereas, with blockchain, with stablecoins, that is going to be instantaneous. So it's, there's quite an exciting outlook for us going forward. So just to touch on the challenges that we've sort of faced and looked at as we sort of moved through, and things that sort of come to light as we sort of undertaken this endeavour. I guess to start off with, there is no fiat-backed UK domiciled stablecoin in the UK that is regulated. There are options, but they generally involve the Jersey or the Isle of Man, and from a regulatory perspective, that's not great. There's a massive lack of transparency there, and it's not something that's going to be favourable from institutions and also from the retail perspective as well. There's also, I always think back to sort of when FTX went over, and sort of the options that we had at that time. You sort of had two scenarios. You could stay on chain in USDC or USDT, but as a UK individual, that's not great because you're carrying a massive currency risk. Or you could go back into GBP, but that generally meant that you had to go into a centralised exchange. And again, when one exchange is going over, the counterparty risk that exists there isn't particularly helpful. Instantaneous international payments are unachievable. So my background is actually in international payments, and if I had a client that phoned me up just now, at 6:30 on a Friday night and said, "Look, Andrew, I'm needing to move some dollars to America," I'd be like, "Okay, great. I'll phone you at 9 o'clock on Monday then." The way that the current banking system operates and banking hours, we're in the 21st century, and we need to have a financial system that can support being in the 21st century. There's no reason that money transfers can't happen, 24/7, 365. And then, yeah, again, today's global payment infrastructure is unable to support T0. That's quite a big deal, especially if you're sort of involved in the financial markets. I don't know if many of you know, but in the US they've just moved from T+2 to T+1. Now, again, that's a massive step forward, but we need to start working towards instantaneous settlement and clearing. I sold some stocks and shares the other day, and the funds still haven't cleared. I have to wait 3 days for the funds to clear into my account, and then I transfer them from my brokerage account out to my bank account, and I've got to wait a further 3 days. That's a 6 working day process to take funds that aren't technically mine and to make them become mine. And we talk about liquid assets, and I wouldn't say that feels particularly liquid. So I guess, just to touch on, well, why blockchain? And, I probably don't need to justify it to the room. There's a good reason that we're here, but it offers, a significant number of good reasons the why, as a form of payment rails and a new sort of a new infrastructure to transact upon, is clear. We have the levels of security that aren't necessarily achievable elsewhere. There's the privacy aspect, especially. Take Solana with their new token extensions. We're able to do a lot in that. On the other hand, there's a lot of transparency, which is again an area that we advocate for. It's good that things are out in the open, and as a stablecoin provider, that's an area that we are very, very focused on, is making it clear to the individuals and businesses that use our product, that they are able to see that the collateral is there at all times, and that their assets are fully backed. Again, with transparency, that's how you get trust. We also talk about trustless, but in actual fact, for people to use our products, we need trust as well. We need them to have the certainty that their assets are safe and that they're being well managed, and there's not commingling of funds, and people are acting as they should. And then, yeah, the bottom two, if there's a reason that we all like Solana, and I think the bottom two are testament to that, the scalability side, and also the performance that gives us, especially, when we start talking about transactions per second. So, yeah, just, to give you an idea of the potential that we see for adoption and growth, at the moment, the data is not great. I'm not going to lie about that. But HMRC think there's about 5.6 million individuals in the UK that use cryptocurrency. Now, how they derive that figure, I won't really go into. But I would advocate that it's probably more. And then of that, 25% of those individuals hold stablecoins or have held a stablecoin. And so as we see this as a large market, but that's very much the foundation and not the ceiling. We only see that figure going to rise, especially when we start to develop what we can actually do on chain from a payments point of view. So this is really sort of the nitty-gritty of what I want to talk about, and it's really the angle that we've had to approach this. As a project that wants to be compliant, transparent, and trustworthy, we've always tried to embrace the objectives and the vision that the regulators have. We've been sure to work with them in developing what they want to achieve, but also making sure that they do so in a way that works for us. So the best way to describe it is the FCA are focusing on non-systemic payments, and the Bank of England focus on systemic payments. To give you an idea of what systemic and non-systemic is, if Tether and USDC had real-world use cases in the UK, the Bank of England still wouldn't consider them to be systemic. So I think that gives you an idea of the scale, which is why we're very much focused on the FCA side of things, and not the Bank of England side of things. Now, I guess just to tie this back, how is this relevant to everyone, and why am I talking about it? Stablecoins are very much the foundation layer of regulation from the regulator's point of view when they look at digital assets and sort of blockchain as a whole. They see that as their way to enter into regulating the ecosystem. So if there's anyone in this room or anyone that watches this that's thinking about or is building, any kind of finance protocol, whether that's borrow and lending or some kind of exchange, etc. The sort of objectives that have been set out by the FCA when it comes to stablecoins is probably a good bit of work to pay attention to, because it's likely that you'll have to follow similar kinds of rules. So at the moment, the FCA will regulate the issuance and the custody of the funds. So basically the mint and burning of it and how those funds are held. And at the moment, they aren't too concerned about, or they've not really developed how they're going to manage funds that are used institutionally. It's very much focused at protecting retail and the retail consumer, and that can be seen as well in what they've done around crypto and digital asset promotions. So, like I said, it's really the issuance and the custody, and also it's stable coins that are going to be used as a means of payment. So really, I guess, as I touched on with USDC and USDT, they're very much in their own ecosystem. They're staying on chain, and those funds aren't ever really coming into the real world. Where regulators start to get interested is when there's that crossover between the real world and on chain. Now, that might seem like it's quite far away, but I actually think that this is something that in 2 or 3 years we're going to see a lot more of, especially as you start to listen to a lot of finance firms talking about how they can tokenize current financial products, but also the move into the tokenization of real-world assets as well. So the FCA came out in their discussion paper that they published earlier, at the end of last year, 12 key objectives, which I'll quickly run through, and that's really why it sort of, it ties it back as to, if anyone that's thinking about doing, any kind of finance protocol. So they touch on sort of the backing, the remuneration, the interest, the safeguarding, the record keeping, the shortfalls, the excesses, CAS, which anyone that knows finance, we don't really like talking about CAS. It's pretty boring. Auditing and reporting. Now, again, I think that's a really, really important point to hammer home, and we'll go into a bit more detail when we get down to it. I don't think there's enough auditing and reporting done on chain by all projects. And I think that's a side that they let themselves down upon, and it's definitely an area that I would advocate for more of. I don't think if you act as you should, that auditing and reporting should be a big deal. Client assets, again, that filters back into the audit and reporting. Independent custodians, that's again an area that we've been very conscious of, and then finally the redemption of assets. So, backing of assets now, without shilling our own project, this is an area that we've been really, really focused on, in the sense that if you want to build the trust and transparency that we need to have the adoption that we want to get, you can only go into the best kinds of what we call HQLA, which is high quality liquid assets. Now, what is that in the UK? It's government gilts at the moment. There's question marks and there's discussions going on as to whether we can use corporate debt and what kinds of corporate debt we would want to use. It would be favourable for us to use corporate debt. It's higher yielding, which means that we would generate more money. However, I think at least as a starting point, it's got to be government bonds, and that's it. There's obviously other projects that have been set up. Take Athena for example, that are using, it's an algorithmic stable coin, and there's people that are experimenting as to whether they can create a stable asset through the use of options. But I think when you're trying to persuade regulators to look at a new means of payment within the UK, we have to make it as boring and as uninteresting as we can. Remuneration. So again, stablecoin providers in the UK, at least initially, are going to make money from the interest that they receive on the assets that they use as collateral. Now, I know some stablecoin providers have gone the other way, where they pass the yield on to their holders. There's a question mark there as to whether that even is a stable coin. Because it's basically a tokenized bond. But it suits us that that's the case, and as you can see in point 3, no interest. Now this is it's an important point for us that we as a firm have to receive the interest and that we cannot pass it on. The argument there that suits us is that we receive that income as in return for providing a service, and that the alternative, which is the route that the Bank of England have gone down, is that you would charge transaction fees. Now, if you look at the likes of Stripe, for example, they charge 2%. That's a sort of a good average figure. That's quite that's quite a cost for consumers and individuals. And if we're wanting to create a system that is, faster and cheaper, then, we need to ensure that there is that advantage. And with us being able to receive the interest, it probably works out better for all parties. The safeguarding of assets, so FC are going to apply their sort of traditional means to manage that, and that's through CAS. I'm not going to talk too much about CAS because my girlfriend works in financial services, and I know from her experiences that it's a pain in the arse. And it is one side that we're not really looking forward to, but it's a side that we're very, very conscious of. And again, the CAS side also filters into the record keeping of how we, attest for our collateral. And again, that's an area that we're looking at. There's various scenarios and options that businesses do. Some businesses go to monthly attestation, some are weekly, some are daily. There's the potential that we are able to actually our collateral can be tokenized as well, which means that it gives us the ability to have a live figure, not just a daily figure. So that's quite, there's quite a lot of exciting things that we can do on that side to really hammer home that things are as they should. Shortfalls, again, similar to excesses, that's on us. You can't have it one way without the other. If there's excesses and we're oversubscribed, then we either have to mint more tokens, or we take the excesses out. And same with shortfalls. If there's a shortfall of funds, that's on us to find those funds. We can't just suddenly tell everyone that their pound isn't worth a pound, that it's actually worth 98 pence. I'm not sure that would go well. Yeah, and then again, bringing in a compliance officer, while that's not cheap, it's certainly a wise thing for us to advocate and for us to do. I think there's a lot of firms that are looking at coming into this space that aren't really embracing the regulatory side in the same sense that we are. And when we talk to other parties, be it third parties that we're wanting to work with, or other businesses, that is quite a novel thing. But I think it's a good step to make, because if we want this infrastructure to sort of move out from sort of the side that it's into a broader spectrum, we have to do so in a way that is going to be comfortable for mass adoption. Auditing and reporting, again, I think I touched on that a bit earlier. It's an area that I've certainly been very keen on, that we have when we're sort of building out our own technology, that we have the means that we can continually have the oversight that we want to have of the assets that we're managing, both on chain and off chain. Because when we launch, we're going to be across 30 different chains. That can actually get quite complicated. There's the potential for exploits there, because you're not just on one chain, and when you're issuing, there's question marks as to how best you issue. Do you issue straight onto one chain, or do you issue onto each chain separately? Because there's basically there's a lot of pros and cons. It's an area that we're sort of testing at the moment as to the best way forward. Looking at the security risk of minting onto each chain individually versus minting onto one and then effectively bridging across onto others. Client assets and money return. So this is basically just how we look at the assets that we have and how we report on them. And then I guess, point 11, independent custodians. This is the point that we've been really, really focused with, and it's an area that it was one of the first things that I went and did after, the conversations that I had with the Solana Foundation and various others when we sort of came into this project and set it up, was to go and identify which custodians do we want to work with and how would those relationships go forward. And I think it's important, especially when you look back to the likes of FTX, that you have those Chinese walls, not just internally but also externally between firms. It just really hammers home that trust and transparency side of things. Both Zodia and Copper, who we've been speaking with, have been very, very helpful, and the technology that they're also able to provide us with is very useful. Redemption is an area that we've spent a lot of time thinking about how we're able to redeem at with T0 redemptions. If we can't redeem, and if we're at 24-hour like Circle, or if we're more than that, then it kind of makes us a bit irrelevant. There's no point being able to be an off ramp between the real world and on chain if you basically can't put your money where your mouth is. So we've spent a lot of time developing that side of things, and it was a key objective of mine that we were able to redeem assets at par at all times, but also do so in a way that is instantaneous. So I guess just not to sort of dwell on this bit in too much depth, but what duties do we have as a sort of financial entity to consumers? And that's really, we have to deliver the consumer needs, and we need to think about the obligations that we have to our clients, throughout the life cycle, and that's ensuring that the assets that they have the protections that they need at all times. It's not just once we're issued, then they're out. We can forget about them. We have to put in policies and processes that allow us to monitor the transactions that are happening on chain. Now, that isn't meaning that we're gonna stalk people and see that they're going down to the shop and buying their bottle of juice for £5. That's basically working with the likes of chain analysis and TRM to ensure that funds aren't being used by bad actors, either in scams or terrorist financing is a massive area that HMRC are spending a lot of time looking at. And I think that's an important aspect for us to develop and to be conscious of, that when we are issuing and especially redeeming funds, that we know that where those funds have been and how those funds have been used. So I guess it's also the next two I won't spend too much time on, but lastly, point 4, communication, and it's an area that I guess cryptos or digital assets and sort of that whole side of things has had a bad name with the way that sort of financial promotions has worked, and that's an area that we've been very, very careful with. So we haven't really been promoting ourselves at the moment, and we've been very low key about what we've been doing. We're not in stealth, but we're also not shouting about it, because we know that the way in which we communicate has to be done in a certain way at a certain period in time, and that needs to be done so from our point of view to protect us as a business, but also to protect the consumer and make the consumer aware of the risks that they are taking on when they, for example, put a lot of money on chain. There is the whole side of things that you're self-custodying your funds, they're yours, etc. But when things go wrong, you don't necessarily have the same protections that you might think that when you've got a bank account. So it's an area that we're looking at, and we're trying to be very conscious that we don't ever mislead anyone at any point. So I talked about custody slightly earlier, and for me, it's an area that I think is actually one of the most important in any part of the infrastructure that we're building, is how the assets are custodied, both on chain and off chain. It would be very, very easy for us to self-custody both sides of that, and for us to manage our own funds. However, I don't feel, for the way that we're trying to align ourselves, that would necessarily be particularly appropriate. So obviously, we all sort of know the benefits of self-custodying. You can be You can be anonymous, you can be online and offline. There's various techniques that we can have, and working with our custodians, that's something that they're able to offer us that, you know, would cost us a lot of time and money to develop the levels of security, especially on the mint and redeem function. And that's an area that, again, I know we spent quite a lot of time in a lot of places, but we have spent a lot of time. It's an area that we're really trying to look at in great depth, is exactly, you know, when someone sends a transaction to us, at what point do, you know, we basically have it so that they pass through a certain number of gates, and there's various triggers that happen at each gate. And so, you know, at what point do we actually mint? And then at what point do those funds actually go to the customer's wallet? Because once those funds have gone to the customer's wallet, they're out there. And so we need to be certain that we know that we have full receipt of the funds that we expect before we mint. So that's an area that our custodians have been very, very helpful with, working with us on that, because it's an area that they're trying to, you know, it's like an 11-stage transaction process, and it's an area that they've spent a lot of time on really trying to understand as well. Also, custodians take a lot of liability away from us as an organisation, and anyone else that's running a protocol. I would recommend that you look at doing this as well. You know, if you're holding team funds, etc., you should look at working with a custodian for that, because, you know, I know you can put things into a multi-sig and you can say that they're away and that they're protected, but are they really? You know, I was involved in a previous project that had a multi-sig, and the funds were meant to be away from everyone. But yeah, there's still, you know, when a bad actor wants to do what a bad actor wants to do, they can find ways. So, you know, working with a custodian gives you that extra layer of protection, and I think it's a worthwhile cost for the benefits that you receive. So what happens if a custodian fails? You know, at the moment, there's not really a clear regulatory framework around this, and it's an area that we've been speaking to the FCA about. You know, how do we manage this? Because really, up until one does fail, no one really knows. It's kind of like the banks. You know, banks never fail until they do. However, we don't think, you know, it says here potential loss of assets. We don't think that would be the case, you know, because there is the separation with the custodian the same way that there's a separation with us. So again, just to touch on sort of areas that we've been developing, you know, our controls and governance. And I think trying to bring, you know, people that have, like our team, you know, that have been involved in sort of DeFi projects and sort of trying to work with governance structures, you know, without trying to turn us into a TradFi business. It is a very useful thing to do, to go through the different processes that you need to understand if certain situations arise. How do you manage them? And yeah, again, you know, just similarly to that, how we manage our clients' holdings, how we protect our clients' rights to their assets, and also the arrangements that we have as an organisation to ensure that there's minimum loss. You know, should anything happen to us, that there is the segregation, that, you know, there is the bankruptcy protections that we are going to put in place, that assets are held in trust and aren't held, you know, by the company. So there is that clear line in the sand. And again, you know, anyone that's operating, for example, a borrow or lend protocol, you know, even if that's on chain, that they also put in those protections. Again, you know, I guess I've kind of touched on this on the previous side, but if it all goes wrong, what happens? You know, who could fail? You know, we could fail if we can't, you know, say yields drop away down and we can't find other significant yield sources, or, you know, the FCA go down the route of the Bank of England and say, well, you've got to go down the transaction fee route, and you know, the economics of that completely change, and without ripping customers off, it's not the viability there isn't necessarily, you know, it's not necessarily going to be viable. You know, the firm safeguarding our backing assets, you know, although, you know, the asset managers that we're working with hold significant, you know, hundreds of billions under management. You know, there's plenty other firms in the past who have held hundreds of billions of funds under management that have gone bust. And, you know, it's an area that we have to look at and be sure that we have the protections in place that should that happen, that customer funds are safe. Because if you go into a fund structure, your funds aren't protected the same way that they might otherwise be if they're held by a bank. And then our custodians, what happens if they if something goes wrong there. And that's one reason that we've been very sort of certain and conscious of who we decide to work with. The key custodian that we're working with is owned by a tier 1 bank, and that gives us the confidence there that there isn't going to be the same level of risk that there might be working with someone smaller, slightly more boutique. And then this is just a slide touching on what would happen to the assets. Ideally, we're able to redeem at par. If we do our jobs right and everything happens as it should. Well, if we do our jobs right, we wouldn't go bust. But if that did happen, we're able to return everyone's assets at par. And I think as we have seen with the situations that have happened over the last couple of years, that has been the case, partly due to the way that assets are structured, but also partly due to asset prices. However, with a stable coin, we would like to think that we have the protections in place and it all goes to plan. So that was a bit of a whistle-stop tour of some of the compliance points of view that we're having to take into account. Hopefully I've not sent you to sleep, but if anyone has any questions as to compliance or what we're doing, fire on.